Cathie Wood is out there with some interesting comments, folks. We got to react to this here in the past 24 hours. Cathie Wood has come out and talked about the Fed, kind of her outlook on the market and things like that. So we're going to go ahead and react to that. Also, this video I want to react to, which is almost like to be honest, like an opposite video of kind of the Cathie Wood video, to be quite frank. And as with all things in life, we got to be equal here. So a Goldman Sachs chief U.S. equity strategist basically believes the Fed won't be pivoting anytime soon. So we're going to hear what his reasoning is behind that. I'll give my opinion on that. I think that should be very interesting to get into there, okay? And then a little fun one at the end. Fubo stock got upgraded. That's a little 1-minute video that I'll react to there and kind of give my opinion on that. So busy video as always. I appreciate everybody for joining me as always. And guys, I was looking at this because I was like, this is insane. It seems like every day the subscriber amount goes up like 100, 200, 300 subscribers. I was like, is this real? So I went to Social Blade. I haven't been on Social Blade in a long time. And I typed in the channel, and this is what I found. I'm like, holy smokes, this ain't no dang joke, because every day is like 100, 200 subscribers. So I just want to say thank you so much for everybody that subscribed to the channel. I appreciate you guys. I try to find you interesting stuff to react to here and obviously give my opinion on it. So I just want to say I appreciate everybody that subscribed to the channel. Much love as always. If you're looking to join us in the private stock group, by the way, that's going to be the pinned comment down there if you're interested in joining us in there and joining us in the Palantir Discord chat, the Tesla Discord chat, and all the others, as well as get access to the course curriculums, our investor reports, all those sorts of things, okay? Alrighty, guys, let's go ahead and jump into this. And if you got an opinion on anything discussed in today's video, I'd love to hear from you in the comments section.
Coming on with us. Let's start broad. October is certainly off to a strong start, and it feels like the bulls are hoping that the Fed may not be as aggressive going forward, something that you've repeatedly called for. That sentiment did underpin the summer bear market rally, but ultimately led to new lows. What is your read of the moment of market sentiment?
Well, interestingly, our strategy did not hit new lows, our flagship strategy, and that is quite normal toward the end of a bear market. We did see the broader averages hit new lows last year.
We'll listen to her here, but I do want to fact check that. I just want to see this because it's got to be close at least.
And yet we maintained our low, which was actually back in mid-May. Innovation tends to be the new leadership as we move out of a bear market. And if we're right and the Fed's close to pivoting, whether in rhetoric or otherwise, and they have a lot of reasons to pivot, even more now after the LDI crisis in Europe, we may have something similar going on here in the United States. And we also have big deflation in the pipeline. Just one commodity price after another has been capitulating. And so that's at the beginning of the pipeline. And then at the end of the pipeline, we have inventories over.
So it looks like factually she's correct on that. ARK did not hit a new low, but it got very darn close from what it looks like there. So do keep that in mind.
Whelming companies. And we have a consumer that is not playing ball as much as he or she was before. So we think this
something to keep in mind about the consumer is the difference in spending and where folks are spending that money, right? And this, not just everybody kind of pays attention to inflation. It's like, hey, a gallon of milk's more expensive, or you shouldn't be drinking milk. Drink some Oatly, okay? Some Oatly's like Oatly. But folks look at it like that, right? Oh, people have to spend more at the pump or on electricity bills and things like that, and that's fair. But also do keep in mind, 2020, 2021 spending, a lot of that was on things. Okay. And now people are spending on a lot of experiential stuff because the world opened back up, especially obviously this year and toward even the end of 21. So, for instance, I went to a concert a couple weekends ago. That was at the Raider Stadium, probably 50,000 people there, 60,000 people there. And those tickets, I think were the cheapest tickets were probably $150 or $200, right? And so, that many people going to see that concert, and this is happening all around the world, obviously, right? And concerts were non-existent a year ago, 2 years ago, because of Rona, obviously, right? Put on the TV on a Saturday afternoon, what you're going to see is college football stadiums full with, 80,000 people, 100,000 people that are spending, obviously, money at those stadiums that weren't able to do that a year ago, 2 years ago, right? Turn on an NFL game, same thing. So, the world's kind of gotten back to normal there. Travel's obviously opened up, and it was a huge travel summer for sure over this past summer. So that is just something to keep in mind. Spending went to more normal levels now, and it's not just buying a new iPhone and new stuff. It's like, I'm going to go spend on the trip. I'm going to go spend on the concert and those sorts of things. So do keep that in mind. 2023 will kind of be, I call it the evening out of everything in terms of just, getting to consistent levels on both kind of categories in terms of things and then experiential type stuff.
Holiday season is going to be quite tough and is going to include a lot of discounting. We believe that the Fed is going to be quite surprised at the deflationary pressures that start hitting the headline inflation numbers during the next.
What's interesting is I've tried to look for this massive discounting, because we've heard about, companies' inventories are up so much, okay? I go to Foot Locker, which I personally own Foot Locker stock. So I like to shop at the companies I own, right? So I shop at Nordstrom, Foot Locker, places like that, because those are in my dividend account, right? So I go to Foot Locker, and I'm like, hey, everybody in the world's talking about this inventory so high, so I'm going to get some good deals. I go to Foot Locker, ain't any good deals, man. I ended up spending like $300-something this past weekend. I'm like, wait, where's all this discounting? What's going on here? Maybe at least it wasn't at Foot Locker. I go to Target like 65 times a week. Okay, maybe not that much, once a week. But when I go to Target, I see hardly any discounting, to be quite honest. And I don't know. It is what it is. It's like there's all this talk about discounting and, you're going to get all these great deals this holiday season. Just wait, man. And it's like, we'll see. Don't get your hopes up about that. We'll see. And do keep in mind, a lot of these retailers have reported these unbelievable high inventory numbers gone up. But remember, they were all down in inventory in a massive way. Remember all the empty shelves and stuff like that? So you're playing some catch up there. And I don't even think that processes with a lot of people. I think they just hear this number of inventory's up 40%. They're like, oh my gosh. Well, when your shelves were empty, inventory better be up. And it better be up substantially, because you got to fill all this product that you didn't even have before, right? Because the supply chain mess up and then stimulus, and we can go through all that, right?
3 to 6 months.
So, Cathie, are you anticipating an actual pivot or a pause? Does that happen sometime next year after what you say may be a rough holiday season? I mean, even though the Fed has said that they remain determined, they need to see more of this. Do you think that that's possible?
Just to explain to anybody that doesn't understand that, essentially, a pause, meaning basically at the end of this year, they stop raising rates going into 2023. So they just, stop ticking it up, essentially. A pivot, a lot of people, the way they look at that is the Fed actually starting to lower rates. So let's say it gets up to 4.5%, let's say hypothetically, right? Then all of a sudden they lower it, a quarter point or something like that down to 4.25, or they lower it down to 4 or 3.5 at that time, something like that. Okay. So I think that's a very important question. Let's hear what Cathie has to say on this.
I think that the Fed is looking not just at the economy now, which is pretty weak. And if you combine that with the notion that our major trading partners are in recession, I'm sure they're on guard. But there are also signs that there's distress out there in the financial services sector. We've been watching the credit default swaps of money center banks doubling and tripling. And in Europe, they're out to all-time highs. And so there are stresses and strains in the financial system that I believe have begun to show themselves, first with the LDI crisis in the UK. And the reason this is happening is we are experiencing a major financial shock. If you look at, Volcker is, Chairman Powell is invoking Volcker's name and his Keeping at It book title, because I think Chairman Powell thinks we have an inflation like we had in the 70s, 80s. Chairman Volcker increased interest rates from 10 to 20% in an inflationary environment. That's twofold. Chairman Powell and team have increased interest rates 13-fold from their lows. And we believe when history books are written, that economists will be looking back at this saying, wow, what a shock to the system. And so I believe credit default swaps are going up for a reason, and we will find out what those reasons are over time.
Yeah, so what was interesting about Cathie's commentary there, okay? Did you hear what I heard? She says the economy is weak right now, right? From my observation, there's a difference between the economy being weak and the economy not being as strong as it was, right? If, let's say we got a professional bodybuilder, and I don't know, he takes a month off, and instead of benching 550 pounds, he only benches 475 pounds. He didn't become weak, he's just not as strong as he once was, right? And the way I look at that is the economy. I think we've gotten very confused on what a weak economy really is. A weak economy is an economy where you can't get jobs anywhere. A weak economy is where people aren't spending money. I like to go out there in the real world, and I like to kind of see what's going on, right? And I told you I went to Foot Locker this past weekend. Foot Locker was busy. I went to Nordstrom. I wouldn't call it busy, but I wouldn't call it dead. It was something in between. I went to the Planet and chilled out in the parking lot for a bit, and that was very, very busy. I was actually surprised at how busy it was for a Sunday afternoon. And, try going to restaurants. Most good restaurants are very busy, and especially, on the weekends and whatnot. So, I just think we've gotten very spoiled with kind of understanding what a weak economy is versus a weaker economy than what we may have had a year ago or something like that, okay? And I just think we got to keep that in mind, okay? If Usain Bolt can't run as fast today as he could have 5 years ago, well, it doesn't mean Usain Bolt's slow now, okay? Because he could still beat almost anybody in the world in the race, right? And so I just think these are some things to kind of keep in mind, and I just think we've gotten very, very spoiled, and we don't maybe fully grasp what a true weak economy is. And as somebody that came into the workforce and I graduated high school in 2008, and I tried to enter the workforce, and lucky enough, my brother hooked me up with a job as a dish cleaner at Einstein Bagels for $7.50 an hour. And then from there, I got the job at Walgreens making, $8.25 an hour. Like, I got to see a real weak economy, a true weak economy, okay? That's a whole different ballgame than the situation we have going on. So I just think those are some things to kind of keep in mind there. We've gotten a little spoiled over time. All right, next video up here to react to. Fed won't be pivoting anytime soon. Okay, let's hear what Goldman Sachs chief U.S. equity strategist has to say here.
That the Fed's going to have to pivot at some point because of financial stability concerns, and when that may be and what that means for the market. What's your take?
Well, the take at Goldman Sachs would be that
Don't buy that, okay? What you need to buy is either something from Elf on the Shelf, but especially honest beauty stuff, okay? Honest beauty stuff. And, people always want to know my skincare routine. Elf on a Shelf, a little honest, my bonest. I still
Fed is in the process of tightening financial conditions, and there are a number of components to that. You've been emphasizing the Fed funds rate, which is certainly a decision, but there's also the level of the 10-year bond yield. There is credit spreads. There's the dollar. There are equity prices. All of these are contributors to a measure of financial conditions, and the idea of tightening financial conditions would incline ourselves from a strategy point of view to focus on higher quality stocks, and we can define higher quality companies in the context of stronger balance sheets, less variability in their growth rates, a higher return on equity, a return on capital, less drawdown risk over time. These are some of the attributes that, historically speaking, Alex, have tended to outperform. Companies with these attributes have tended to outperform in environments with tightening financial conditions, which I think characterizes the financial environment that we're in right now.
Which is, the reason I was smiling there is that's just the same Wall Streeter types talk. They've been talking, over the last several months in the market. It's a flight to what they perceive as quality, which could be things like oil and gas stocks. If that's what they perceive as quality, it can be stocks like an Apple stock, for instance, right, which is perceived quality. But the interesting thing is a lot of those Wall Streeters have sold off almost everything, to be quite frank. As of two trading days ago, Microsoft was sitting at a new 52-week low. We had Google stock trading at a new 52-week low. We had Amazon stock not quite there, but getting close as of 2 trading days ago. So even the most quality names other than Apple had been down quite substantially. And obviously Apple's been beaten up as well. It just hasn't been beaten up as bad as many of the others out there. So I just find that interesting that even despite them talking like that, they've beaten these stocks up. Look at the banking stocks, right? That including a lot of these Wall Streeters work for. Those stocks have all traded to 52-week lows, and some of them even multi-year lows, to be quite frank. And some of those to even prices that they were at 4, 5, 6 years ago. So does that mean the institutions that these individuals work for are not quality? That's just something to think about, right? Just think about these things for a moment, okay? Think about what you're thinking about. Oh, shout out Mav, okay?
David, were the Fed to pivot, though, how different would that list look like? What kind of stocks, what kind of assets would you want to own in an environment where the Fed is pivoting?
Well, God, it's a question, sort of hypothetical, which is if they were to do so, what are the impetuses? What would prompt the Fed to do such a thing? Well, it might be that the economy has slowed to a certain degree, such that there's concern about tipping in a recession. It's not the baseline view here. In terms of what companies would do better then, well, some of the much more defensive-oriented companies, value in particular, would come to the fore. Thinking about that as an attribute as opposed to growth. On the other hand, if the idea of the Fed's pivoting and rates are falling, that could benefit some on the growth side. So think about it as a balanced portfolio. Mm-hmm. What would be the reasons for it? I think becomes the critical question. Yeah. And it's to underscore the fact that it is not the view here that the Fed is likely to be pivoting anytime soon, and given their dot plots and the commentary. My colleagues in economics tend to focus on that more than I do, but certainly it's highly relevant to the equity market, no doubt.
Yeah, absolutely. And you guys, taking a look at your view in particular, you have 4,000 on the S&P for next year in a soft landing scenario. You have 3,150 in a recession. In the 3,150, what's your base? What does the recession then look like, and how do you manage that risk?
Before it gets to that, I want to make a very important point. You hear what we're talking about here. The fact that we're even discussing the Fed pivoting potentially anytime soon is a step in that direction, right? Because you take that step where people are like, no, they're not pivoting anytime soon. But the fact that you get to that conversation is important, because you couldn't even have had this conversation 2, 3, 4 months ago, right? So now that you're getting that conversation, okay, that's a step in that direction, right? The next step in the direction, maybe a month or two from now, is like, hey, I'm pretty sure they're going to pivot soon or pause, right? And then more people are convinced of that. And then maybe a few months after that, then it becomes conventional thinking that they're either pausing or pivoting very soon after that, right? So it's kind of like steps in that direction. And we're at the phase where now this is a debate. And some folks are no, there's no way they're pivoting anytime soon. The other folks are like, you know what? They're either pivoting or they're pausing actually within the next few months. As we heard, we listened to that in the video I reacted to yesterday, where that gentleman who's been very bearish on the market now all of a sudden says, last time the Fed's going to raise rates is December, he said. And then he expects the Fed not to raise anymore and just keep rates steady. And then potentially at 2023, at some point in time, even lower rates. Hey, that's just kind of something to keep in mind there. It's a stair-step process. Let's call it that.
Well, to be very clear, let's lay out some of the path for both of these. So in the baseline expectation is that the Fed is able to manage a soft landing, so the narrow path to a soft landing. And what would that would involve the economy slowing, the labor market slowing, and inflation, most importantly, coming down. And to the extent that happens, the economy continues to grow, and that would basically be consistent with some of the higher quality stocks continuing to do better. And that would sort of be the baseline forecast. And Alex, you want to think about the level of the S&P 500 at the end of this year, somewhere around 3,600. That would be the building blocks behind a story of around 8% earnings growth this year, decelerating to around 3% earnings growth in 2023. And the idea of a decelerating economy, a decelerating earnings growth, but still positive, that would be consistent with a multiple of the market, somewhere in the 15 or so times multiple range. And that's the expectation, and I would say that's most probable. To the extent that their investor community is...
Before we let him continue there, I had a really important thought, and I thought I would pass this out to the universe, right? If you think about what really moves the stock market, it's usually the biggest of the big companies, right? And those are usually companies that sell things, let's say, for instance, right? Think Apple, think Google in terms of their ad business, because people are selling products and services through Google. That obviously helps out their revenue. Meta, you can obviously get into them, right? Amazon, all those sorts of companies, right? In terms of like automakers, in terms of like home builders, things like that, those actually don't move the market at all. They help out the economy, but they're not market movers. Like housing stocks aren't moving the market at all, even remotely, okay? And so if you're talking about interest rates being in a higher environment, right? So people don't want to make big ticket purchases like buying a new home, like buying furniture, like buying a new car and things like that, right? Well, that's a lot more money that can be spent other places, right? Because you're not using $50,000 to buy a home right now because you're like, I'm not paying 7% mortgage or 6% mortgage. Heck no, I'll wait, maybe talk to me in a year, talk to me in a few years, and then we can chat about that, right? If you're refusing to buy a car because cars are super expensive right now, it seems like there's no good deals. Inventory is still a little tight depending upon what vehicles you're looking for, and obviously interest rates are elevated. Well, then you have more money to spend other places because you're not buying that car and putting that $5,000 down, that $10,000 down, right? If you're not buying a new house, you're probably not going out there and buying new furniture and things like that, right? And furniture companies aren't moving the market. That's just a bottom line. And so therefore, you have money to spend other places, right? Which could be a new iPhone, which could be, some stuff that you buy off a Google ad or Meta or whatever it is, right? And so I just think that's important to remember, like, if money's not being spent there, it can be spent over here, right? As we spoke about earlier in this video about like experiential spending, obviously this year versus, 2020, 2021, where it was just basically on things, right? And so I think it's just all these things kind of have to play out, and you have to kind of see how it all is going to shake out. And it's just, time has to tell ultimately in the situation. It's just, when you have a shock and awe event like Rona was, it just caused a lot of confusion in the economy. How strong or weak is the actual economy? How strong or weak are these companies' earnings, the stock market in general? And it obviously caused everything to get messed up. Like just think about over the past 2 or 3 years, the financial markets have been chaos. Let's just call it what it is. Since Rona, the financial markets have been chaos. The stock market, insane down, then insane up, then insane down, right? You look at treasury yields, you look at the bond market, you look at real estate. I mean, everything has been in complete chaos since Rona happened in the financial markets. And to a point where we haven't seen it in this much chaos, other than maybe the great financial crisis and maybe back in like the 70s. Like we're talking about decade or multi-decade type chaos in the markets, all because of Rona, essentially, right? So that's just something to keep in mind there.
Pivoting, if you want to use that term as your word of the day, pivoting towards a likely recession, and there would be much greater concern. Market would be trading, in our view, something towards the bottom end, say 3,400 at the end of this year, and ultimately, as you indicate, troughing sometime sort of middle part of next year to trough around 3,150, and that would be consistent, importantly, with the rate market moving a lot lower, and the idea of real rates, which started this year at around negative 1%. A couple of days ago, it was positive 160 basis points, and that pulled back to around positive 130 basis points. So the rate market has been, critical in terms of assessing the level of equities, broadly speaking. But the idea of the end of this year, the next quarter, this quarter, fourth quarter here, we just started, sort of 34 to 3,600 would be the kind of bid-ask range around where we trade, with the idea of the economy slowing, inflation perhaps coming down slightly, and the idea of the earnings slowing as well.
All right, interesting. So I'll be honest, I really like how negative he is. This is Goldman Sachs' chief U.S. equity strategist. It's a very important role at Goldman Sachs. And I like how negative he is when he's talking about 3,150 for S&P 500 next year. That is very bearish, very bearish. And so I think the important thing to remember is when people are going into a year that bearish, right? They can definitely be caught off guard. Maybe he's right and we go down to 3150 or something like that happens. But I just like when that's a perspective going in, because now expectations are so incredibly low. When you have gotten yourself to that sort of place where you believe the S&P is going to 3,100 or so, right? You have gotten incredibly bearish on the market, right? And you are just seeing so many negatives. Well, if suddenly you start seeing a positive here, a positive there, you start to have to shift your strategy, right? And you can't be too caught off sides in this, and the market starts moving the other way. You have to jump on, just bottom line, and I can almost guarantee you these same folks that if we went back to October, November of 2021, I almost guarantee you most of those folks were probably very bullish on the market in 2022, right? So think about that for a moment and look what we got. Look what we got for a market in 2022. Disaster zone. As of 2 trading days ago, the NASDAQ was down like 33% year to date or something like that. A disaster. Like the amount of stocks down 50, 60, 70, 80% this year's ridiculous. And so we got a mess of a market. But if you go back to October, November, all these Wall Streeters were extremely bullish on, what earnings and what was going to happen in the market in 22, and we just got a disaster, to be quite frank. So if you think it can't work the other way, it absolutely can. Doesn't mean he's right or he's wrong. Just it is important to kind of keep that in mind there, okay? And so I like low expectations versus high expectations, because high expectations, it's like being a kid in school, right? And the teacher has high expectations for you. You need to be like perfect just for them to like you a little bit, right? However, if you're that kid who's just bad in class, shoot, if you get a C, they're like cheering for you, like, look at how good you are. Low expectations are usually a little fun.
What's the tail risk multiple on the downside for the market, David?
Tail risk, I would say, would be around 14 times. Would be if you want to think about it as a level. That's not necessarily how we kind of arrive at that. We want to think about that in terms of risk premium models, things like that. But answer your question, probably around 14 times, and that's kind of where we'd see it. The market valuation this year has gone from 21 times the start of the year to around 15 times where we are today.
Yeah. So, David, what kind of profit margin world does that imply?
Well, I think you're setting up the most important development here, which is the big shock to the investment community, both macro and micro, was the CPI reading last month, when the expectation was it would continue to come down, and in fact, it moved the other direction. I think the analog to that in the public equity markets is the third quarter earnings season, which will be coming up, kick off around the 14th of October or so. And the expectations right now are for around plus 4% on the earnings front, year-over-year growth plus 4%. That would be benefiting, if you will, from the energy sector. If you take that away, earnings will be down by around 2%. And coming now to the specifics on the question of margins, the idea of margins declining this quarter is going to be the first time we've seen that in terms of my expectations, and that's likely to continue into next year. Expectations margins will fall next year from around 12.25% this year to maybe 12% next year, and the expectations from the market in terms of the consensus is that margins will expand by around 15 basis points. And that gap of around 40 basis points is the difference between earnings growth of somewhere plus 3 versus plus 7. I think that's the bid-ask debate in the market discussions that I have right now with clients.
David, are you surprised how fully invested the market still is into equities, both retail and institutional?
So the data that we look at, guys, shows something slightly different. We've seen that...
Thank you. Well, like, what kind of question is that? Thank you, sir. What? Thank you.
The last 31 weeks consecutively that the investor community has been below average, and we want to think about positioning across mutual funds, households, pension funds, institutional investors, retirement funds, showing that that's actually below the average, if you will, somewhat modestly invested. You can think about that in terms of the hedge fund community here. The idea of net leverage has come down by 20 percentage points from like 85 to 65% net leverage. That's actually quite low. The cash positions in equity mutual funds are elevated. So those are all indications of relatively more cautious positioning on the part of most portfolio managers.
Thank you. Okay. Now, I think, they were talking about margins there, right? I think you really have to break this out on a company by company basis, right? I mean, there's a lot of companies I personally own that are going to see their margins, I think, explode in 2023, to be just quite honest, and that have had their margins devastated over the past year. because of so many different costs. I can't speak for every company out there, but I can tell you there's certain companies I own where they've had to rely heavily on container costs that has dropped by 60+%. Trucking costs that has come down massively over the last several months that they're going to benefit from, right? Raw commodities that have come down massively over the past 3 to 6 months. And so, unless those things magically shift and go crazy again, which is pretty unrealistic, unless commodities go on some super cycle again and go double up again, and, container rates jump, another 50, 100, 150%, and trucking rates, I don't see that happening. And so therefore, I think there's going to be a lot of companies that are positioned in a great margin perspective and are actually going to see 2023 margins improve not just a small amount, but dramatically, into a point where it's going to shock investors, where they're going to be like, I can't believe this company has turned their margins from ... to this number, and they're just going to be completely blown away. And like I said, I don't want to speak for every single company out there, but there's a lot of them that I personally own that have had their margins wrecked, and everything that could have worked against those companies happened this year. It all got thrown at them, like the worst scenario possible. And all those things have gone away. And so over the next, in my opinion, 3 to 4 quarters, you'll see that in the numbers where their margins go boop, 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 boop. And people are going to be like, what? What's going on here? And all of a sudden you go from a situation where it's like 2022, we saw margins getting worse with these companies. And then 2023, it's getting a lot better. But like I said, I don't want to speak for every single company out there. But even companies I look at, like that are some of the big tech companies, a lot of those companies, don't be surprised if their margins actually improve in 2023. And I'm talking about most of the big tech companies. So this belief that margins are going to go down, I'm not so convinced of that in 2023. I think the problematic margin year was this year in 2022, because you had so much thrown at these companies all at one time, and they literally didn't matter what they did, they could not get their margins to a good place. We'll see what happens, obviously, but that's just kind of my perspective on that, okay? All right, next up here, Fubo got upgraded.
Real quick here that we had on Fubo, speaking of football, on Fubo TV here, this coming from Michael Pachter over at Wedbush, who is upgrading this to outperform from neutral. The stock has really plunged this year, so part of it has to do with valuation, that there's an attractive entry point here. According to Pachter,
that's interesting. $6 price target there. Obviously Fubo has been trading in the 3 to 4 range over the past several months. So, when you're talking about 6, that's a number that's up there, right? You don't have many stocks that folks are expecting to go up that much. So I just think that's interesting in itself. I actually think that number's way low, by the way. But anyways, that's subject
Fubo
for another day.
TV has a solid head start in offering live sports programming to its subscribers, thriving and growing advertising business. The issue with the business has been cash burn, and so
the advertising business is just starting to take off. Wait to see where that is in a couple of years. Holy smokes.
Talks about that the company needs to focus on raising capital and cutting its cash burn to extend its cash runway. He says, we're confident the company can do both, although there could be some dilution from any kind of capital raise.
Get you a streaming service that can do both. At the end of the day, for Fubo as well, and I think they make a great point when it comes to the sports rights and being able to have that streaming capacity. Sports is going to be a major kind of opportunity that Netflix is not going into getting sports licensing outright. Sure, there are other ways that they're trying to backfill for all the lost 30 for 30 content, but at the end of the day, for the sports rights that have been continued to be either competed for, or whether that's by an Amazon and Thursday Night Football, or whether that's even by an Apple, which we'll talk about a little bit later on, I think there's so much opportunity for the annexation of streaming to sports. It's really just a matter of how much all of these brands in the streaming space are willing to pony up for that new customer acquisition, and hoping that they'll consume some of the other content that they're paying millions, if not billions of dollars to produce over time.
Yeah, and so in terms of live sports, it is the holy grail for advertisers in let's call it the television market. This is the holy grail. And the reason being is everything else you can usually skip ads and things like that, right? But live sports, you want to watch it live, right? Like I want to watch the football game unless I absolutely have to record or something. Like I want to watch it now. And so people enjoy live sports because it's happening right now. It's the holy grail for advertisers. There's nothing better than that. That's why companies will spend just ridiculous amounts of money on a Super Bowl ad or something like that, right? Because you got everybody's attention right there at that given moment. And everybody's obviously watching the TV. And so if you think about like I always think about who's in the pole position. And so, in terms of streaming, you have two major players there. You obviously have YouTube TV and you have Fubo. And obviously you have all the traditional cable companies, satellite companies that are going to try to compete, but my light went out. It's not the easiest thing to do. I guess it's been a little bit of a longer video. It's not the easiest thing to do, to be quite honest, when you have some traditional model that's so much different than this streaming model, right? But in terms of who's the number one most positioned for live sports, who has the most live sports, it's Fubo. And so if you are any individual that cares a lot about sports, and as myself as a sports fan, especially football fan, like the number one service I'm going to consider before everything else is Fubo. And then comes everything else. And so I think that matters in actually a much bigger way than anybody even realizes right now. I think down the road, everybody's going to realize how big of a deal this is. And technology that Fubo has just makes it so interesting. And I covered this when I went over Fubo a while back, but you can basically watch 4 different games at the same time on Fubo, which is a game changer, just to be quite frank, no pun intended there, for big time sports fans who love to watch multiple games at multiple times, because you used to have to try to flip back to all these different games. Now you can have it all up on your big screen and, have 4 different games up there at one time if you want, or 3 different games or 2 different games, all on the same television. And to do that back in the day, you used to need 4 different satellite boxes essentially, which is just ridiculous, right? Like who's really doing that? No one's really doing that. So Fubo just made that. All you need is an Apple TV. You got Fubo. You can watch 4 games at one time, which is just insane. As a sports fan, it's like the holy grail. And so they've really got that market down, and I think their advertising business, plus they're just going to keep acquiring customers like insane. And I just think we're really going to see this play out in the numbers. And I mean, the Google Trends doesn't lie. You know what I mean? Like, this is no emotion. And ever since football season started getting close, I mean, the Google Trends went to the highest we've ever seen in the history of this company. So the question is, what type of numbers are they going to put up over the next few quarters? I think it's going to be ridiculous. And the company retains customers really darn well, to be quite frank. So, Google Trends is your friend. We'll see what happens in the numbers over the next, few quarters. But I think, I think that company has some big competitive advantages that unless you're so into this stuff, you might not see it. But once you really dive down the rabbit hole and you're a real sports fan, you start to realize how impactful this stuff is. And, I wouldn't be surprised if they keep innovating there and keep coming out with game-changing stuff that makes people say, oh, man, this is, if you're a sports fan, like you consider Fubo, and then it's everything else, okay? So anyways, hope you guys enjoyed this. As always, much love. As always, appreciate everybody for joining me. If you're looking to join us in the private stock group and get access to everything that we have in there, including our Palantir chat, SoFi chat, Tesla chat. We've got a Fubo chat, and if you're interested in that stock and a bunch of others, that will be pinned comment down there, as well as course curriculums. Much love and have a great day.